Okay, welcome to class. This is Echela Okori. I'm your accounting and finance coach. And today is our second class in the sessions. That's the accounting and finance coaching sessions. Yesterday, we looked at the meaning of accounting and we explained it in practical terms. We itemized the steps of the process that makes it accounting. And we said accountants don't carry out these processes just for the fun of it. They do it because of users. The information so generated is passed on to the users of account to enable them make informed decisions. Today, I want to welcome you. If you are just joining us, this is the free online class to help people who want to become accountants, also to help students who are already studying accounting to sharpen their skills, and also to help professional accountants to stay up to date with their act. So, moving straight away, we're going to bookkeeping today. We want to look at why accountants debit and why they credit. Why are some items credited and why are others debited? Firstly, it is expedient to explain that the father of accounting, that is Luca Pacioli, actually some people will say it's not Luca Pacioli who is actually the father of accounting. Some will say it's Cotrugli, but that is a class or an argument for another day. So I'll leave that for now. But let's say the father of accounting documented this double entry system. And this double entry system is at the core of bookkeeping, is at the core of accounting. So it is very important that you understand the double entry system, because if you don't, it means you do not know the basics of accounting. Now, what is this double entry system? The double entry system simply says that for every debit entry, there must be an equal and opposite credit entry. Now, what is even a debit and what is even a credit? If you are meeting accounting, if you are learning accounting for the very first time, you may not know what we mean, but I'm going to demonstrate it to you in this class. If you have not subscribed to this channel, I want to urge you to quickly do so, and also use the opportunity to invite your friends who want to become chartered accountants, who want to become professional accountants, because this is where we demystify all those subjects, all those topics that seem to be difficult. They are not difficult. You just need to understand the principles, understand the format, understand the standards. Once you know this, it is easy peasy. So let's go straight away to what I was saying before. It is important to know that for every entry on the debit side, there must be another entry on the credit side. In other words, for everybody who receives, there must be somebody who has given. If you receive an apple or an orange, for instance, there must be somebody who gave you that orange. This is the principle of the double entry system. So for every receiver, there is a giver. If you receive your tithes, for instance, you are a pastor, you received your tithes. Somebody must have paid that tithe. There is a giver of that tithe that you received. So for every financial transaction in accounting or in bookkeeping, we view it from two sides. We view it from the side of the person who has received. That is the debit side. And we also view it from the angle of the person who has given. And that is the credit side. So you must have heard that we debit the receiver and we credit the giver. So know this and know that it is very, very important for you to understand bookkeeping. There's nothing serious about it. It's just very simple, but it's fundamental. You need to remember that for every transaction, Remember, I told you that in accounting, we deal with transactions that can be quantified in monetary terms. So for every transaction that you're going to take into the account, you must think of the two sides. Who is receiving and who is giving? If you identify these two, then you know that the receiver is going to be debited and the giver is going to be credited. Remember also that yesterday we learned that the process of accounting starts from the point where we record financial transactions. After recording financial transactions or financial events, the next thing we do is to look for the source document. We record or we keep the source document. The source documents, I told you, are like evidence. They are the evidence of the transaction that happened. They could be invoices, they could be contract, they could be whatever, but they are documentary evidence to show that that financial transaction occurred. After that, I told you also that the next step is to prepare a journal. Journalization is the next process, and is this process where we begin to think of the two accounts that are affected. That for every transaction, there must be somebody who received and there must be somebody who gave. So for every transaction, we journalize by having the date, by having the name and narration, and by having the debit and the credit. That is the two transactions that occurred. Also, we also do this in a chronological order. We journalize in chronological order. You journalize immediately the transaction occurs so that you don't record the transaction that will happen on the 30th of this month before the one that happens today. We do it in chronological order. After the journalization, we now move it to what we call the ledger or the ledger account. Now, the ledger is usually called a T account, which has one debit side and the other the credit side. In other words, the left-hand side is the debit side and the right-hand side is the credit side. So accounting is just easy, it's just fun, it's just very easy to understand. Now, having identified that the debit side is the left-hand side and the credit side is the right-hand side when you make a T account, you must always remember that for every debit, there has to be another credit. Now, I want to demystify the problem of knowing what to debit and knowing what to credit. There are people who have been accountants for many years, yet they have problems with this very simple, easy peasy principle of knowing what to debit and knowing what to credit. To do that, I want to explain to you there's a mnemonic that I'll give to you now, which I want you to always remember. I don't want to take credit for it. It is what every professional accountant knows. We call it a dead CLIC. DEADCLIC. That is DEADCLIC. Now, you can just say a dead CLIC. I want to tell you what this stands for. If you always remember this, you will know that every transaction is going to be one of these, which we call the elements of the financial statement. So, the D in the debt stands for debit. All debits will follow next. That is, the E is for expenses. All expenses will take debit. All assets will also take debit. And the last D stands for drawings. Drawings will also take debit. Now, at this point, it is also important that I explain to you what these terms are. What do you understand by the word expense? How do you know that this is an expense? How do you recognize that it is an expense when a financial transaction occurs? An expense is simply a reduction in the economic benefits of an entity. It is reduction because there is an outflow or there is a depletion of the equity of that entity. What am I talking about? I am saying that there is a payment out. For example, you make payment of salaries, and they are usually what we call operating. So once you make a payment, there's an outflow. Then that outflow is going to reduce the economic resources of that organization. Also, it could be a depletion. This time around, there is no physical movement of cash. There's no physical outflow, but there is a depletion of the economic resources. How does this happen? It could be a depreciation or it could be an impairment. These are two big words, right? But they are very, very simple words which we are going to learn. A depreciation is simply like tears and wears, systematic reduction in the value of an asset as a result of, it could be tears, it could be wears, it could also be by obsolescence. I don't want you to bother yourself with that for now because we're going to do justice to it very, very well. We're going to tell you what depreciation means, how it is treated, whether it is under depreciation or whether it is over depreciation. We're going to demystify it. We're also going to show you all the various ways that depreciation is calculated. Another one also, another of the big words I use is impairment. Impairment also, I'm going to explain to you what the carrying amount of an asset is. That is the cost of an asset from when it was bought, less the accumulated depreciation to date, which will give us what we call the carrying amount, and then we'll compare it with something else which we call the recoverable amount, which is the higher of two things, which is one is the value in use, and the second is the fair value less cost to sell. So if the carrying amount is more than the recoverable amount, then we'll say that asset is impaired. But I'll explain that when we get there. For now, I just want you to know that an impairment means the asset is not as good as it was when it was bought. It has reduced. And if you are going to buy it in the market or to sell it, it is not going to give you the price that you ordinarily think it should be.